Welcome back to EDS, and in this video we're going to take a look at how you can write your own options contracts, how you can collect a premium upfront and generate consistent returns year on year. Specifically in this video we're going to take a look at how you can manage some positions once you've already opened them, and we're going to look at how we've been managing some positions that we've got open, and let's get straight into it. So the first thing, this is what our portfolio looks like at the moment. We've got GDXJ, UAL, SMH, AMD, Canadian dollar futures, and Aussie dollar futures. So first things first, let's just go from the top of the list, right? So GDXJ, right? Right now we've got a straddle on GDXJ at the 48 strike, and we've got 27 days left till expiration. So if you pull up the chart for GDXJ, and then let's just have a look at the order change. So originally we sold the 42.52 strangle on GDXJ, right? And we collected $1.22. Market moved against us to the upside. Market moved against us to the downside, and we rolled our call from 52 down to 48, right? And we collected a 37 cents credit by doing so. Then we got whipsawed a little bit. Market moved up, so then we rolled our 42 put up to the 46 put, or the 46 strike, collected 46 cents in the process. Market just kept moving, and to be fair, we could have done without this roll. We could have just gone straight to the 48, moving it from the 46 to the 48. We could have just skipped this one and went straight from the 42 to the 48 instead of going to the 46, but we did it anyway. It's fine. It all works out to be the same thing in the end. We collected a total of $2.57 right now to close this position. Market is closed. It's a Saturday, but just for example purposes, it cost us $4.23. The difference between those two is what our current P&L is. So right now, obviously, we have still got best part of a month still left on these contracts. We are just gonna let GDXJ hang out around our straddle and just let theta decay a little bit more. As you can see, we've got to put on our call at the 48 mark. 27 days left on the contract. And if we look at where our break-even points are, so the way we calculate our break-even points is we use how much premium we've collected in total, plus or minus either your call or your put. So $2.57 is what we've collected, plus 48. So our break-even on the top side would be 50.57, which would land us just here. As we can see, we haven't breached our break-even point yet. And then on the put side, it would be 48 minus 2.57, and that would put us at 45.43. 45.43 would land us at basically just about there. So as you can see, we are slightly heavy on the call side, but that is the nature of a straddle. You will always be in the money on one of the contracts, unless if price was to be exactly at your strike price, in this case 48. So we're just going to hope that price hangs around in this break-even range a little bit, and data can just keep decaying the contract, and then hopefully we can look for an opportunity to get out of this position with a bit of profit as well. So that's the play for this week. Hopefully we can see that opportunity. Next up, we've got UAL. UAL is another very interesting one. As you can see here, this is an inverted put up here. Okay, so this is the call, right, at 50, and then this is a put above the call, which is an inverted put. So if we look at the order chain, we originally opened this position as a normal strangle, right, at the 35 and the 50 strikes, and we collected $1.10 in premium in doing so. We then rolled the put side up from 35 to 42 as the market moved higher against us, and then we rolled again from the 42 to the 48, from the 48 to the 50, and all the while we collected 70 cents there, 50 cents there. And then at this point, At this point, when we rolled from the 48 strike to the 50 strike, at this point we were in a straddle. Both strikes were at 50. Market kept moving against us, as you can see up here, and then we inverted the put contract and rolled it up to 52.5, collected a nice amount of credit, and overall on the entire position we've collected $3.74. So as you can see, initially when we opened the position we collected $1.10. Now we've collected a total of $3.74, which is crazy. But this is basically what it looks like. When you're right, you're right. When you're wrong, just keep collecting premium and look for an opportunity to get out with a nice bit of profit. So again, this is what we've been paid so far, and 6.22 is what it would cost us to get out. So again, we're just going to let theta decay. If you were to look at our break-even points, so on the top side, remember our put's higher than our call now, so we're gonna use the put contract to work out our break-even for the top side. So it's going to be 52.5 plus 3.74. That puts us at 56.24. So 56.24 is going to put us right here at the top of this recent high, this recent range, or whatever you want to call it. That's where we are on the top side. And then on the bottom side, it's going to be 50 minus 3.74. That's going to take us to 46.26, which is going to land us right about there. So between here and the top of this range, this is where we need price to stay. If price was to stay, our best case scenario is for price to expire within this range here. And at this point, because this range is $2.50 wide, we have essentially locked in a loss of $2.50. That would be our best case scenario, provided that we don't invert it again and then make it the right way around. But if we were to do that, and just leave it inverted, obviously there is a spread there of $2.50. So we do 374 minus $2.50. So that's $1.24 left on the table. So we're playing for $1.24 profit on this position. And that's what UAL looks like. SMH is an iron condor. Again, we have made some adjustments on this iron condor, just one adjustment. We originally opened up SMH as a nice iron condor collecting $1.38 in premium. We then rolled our call side down because the market just moved pretty much straight against us. So we rolled our call side down, collected 62 cents in the process, and we made our total credit on the position $2, which is very nice for an iron condor. It's a $5 wide iron condor, $300 of risk, $200 collected up front. Right now, it would cost us $2.40 to get out. So we're sitting in an open loss of about $40. As you can see, volatility is coming out of the market. We're still within the range. Nothing to worry about here with SMH. We're just going to let theta decay and see where that takes us. AMD is a very similar story to SMH. It's basically identical. We ended up with $2 total premium collected. I really do want to get out of either AMD or SMH this week because they are similar positions and we don't want to have too many positions that look the same. So again, AMD, very similar story. We've got the Canadian dollar futures. We have still got about 50 days left on the contract, 48 days left on the contract. This is a nice strangle. We did collect $200 up front on this position, and we're literally just going to let theta decay, and currencies don't really tend to move too much, so we'll be looking to keep a nice bit of premium on this position. Next up, we've got Aussie dollar futures. We've got 76 days left on this contract. We did go a bit further wider with the deltas on this contract, and we did go further on the expiration date as well. So the deltas are lower, and there's more theta in this contract compared to the Canadian dollar futures. Again, we've only just put this on. We just need to let price do its thing. let volatility contract, and hopefully in the next couple of weeks we can take this position off with a nice bit of profit. So that's a little bit of a look um, on our portfolio and what we've been doing, how we've been managing our positions. There is something else you do need to keep in mind, and it is this position sizing template. It doesn't matter what you do, if your sizing is wrong, then you will blow your account up at some point. The way the sizing template works is you enter in the size of your portfolio. Let's say if it's $15,000. Below, you will then enter in the current VIX level. Let's say if it's at 14.1. Everything below will then be automatically calculated for you. At this point, all you need to do is just use the information to form the backbone of your portfolio, use it as a guideline. It will tell you how much money to allocate to each undefined risk position, each defined risk position, and how much of your portfolio to allocate to short premium strategies in general. And there is also an explanation here explaining everything. To get this template, just click the link in the description, click on the free position sizing template, and it will take you to the page. If you do want to get involved on our trades and trade with us and see what we're doing, by all means, click the link in the description. Head over to EDS Premium and get yourself signed up. Inside EDS Premium, you will get all of our portfolios, large and small. So there'll always be a position for you to copy. There is a full course inside. No prior knowledge is required. So you can learn and earn at the same time. It is a private community, so you can speak with myself and other like-minded individuals. There's a 100% money back guarantee. So if you've studied our full course and followed our trades for 6 months and haven't seen results, then we will work with you for free until you do, or you can request a full refund. So it's completely risk-free on your part. It's £1 a month right now. The price will be increasing. Once you're in, you don't need to worry about future price increases. And with that being said, I'll see you guys on the inside.